Good day. Today is Tuesday, June 10th, 2025, and I'm going to talk about quant versus speculation with examples. I use the word speculation because I want to focus on the fact that most trading system developers focus on absolute returns. They are speculating excessively instead of trying to understand the trade-offs. So I'm not going to go into the discussion what is a quant versus a speculator, or I could have used the term technical analysis or just a person with a back tester to describe the opposite side of quant, but you will get the idea. On social media, financial social media and financial blogs, there are all those trading strategy developers who focus on speculation. They try to maximize the performance in terms of annualized return, basically without paying too much attention to the other more important metrics like the Sharpe ratio, the drawdown, and related risk parameters. So before we start, I would like to make sure that everyone understands there is no investment advice in this video. So let's talk about quant versus speculation, and I will offer an example. It's the dynamic three ensemble versus a futures trend following strategy. Let's move to the next slide. Usually quants are looking for a Sharpe ratio near or above 1. For various reasons, I'm not going to get into this video. We have discussed this in blogs, blog articles, or other videos. They want a maximum drawdown of less than 12%, preferably less than 10%, and volatility of the equity curve should be less than 10%, and the result is an annualized return in the order of 8% in the most cases. Why? Because there is a trade-off between Sharpe ratio, drawdown, and volatility. In most cases, there is no way to get a high annualized return if someone tries to control those risk parameters. On the other hand, the speculators or those developers who have a backtesting program, they end up with Sharpe ratios in the order of 0.5 to 0.75, maximum drawdown, it's 20% to 40%, volatility it's much higher than 12%, and annualized return is higher than 10%. Usually these speculators focus on annualized return, as it has become evident over the years from financial blogs and posts on financial social media. So here we see some basic difference. Between a quant and a speculator. A quant is someone who is trying to analyze quantitatively the trade-offs, understands the trade-offs. Usually a person with experience, skin in the game, and knowledge of mathematics. On the other hand, at the end of the spectrum is the speculator, who is usually someone without skin in the game, without good knowledge of mathematics, who does not understand the trade-offs. Why? Because quants understand that a drawdown of 35% can become a drawdown of 50% or 60%, or maybe in extreme cases 70%. Speculators do not seem to care much or pay attention to drawdowns because their objective is to maximize the annualized return and show this fancy chart that with a high annualized return on their blogs or on social media and try to impress their followers. Quants, on the other hand, they do not try to impress anyone. Usually the results, they are not that impressive in terms of returns. So let's move to the next slide. Now, example of speculation. This is a futures trend following strategy we have developed. It trades 23 futures. And since 1990, the annualized return is about 13.9%, but the drawdown is 33%, and the Sharpe ratio is less than 1. It's 0.79 now. This strategy is speculation. Last year, 2024, it had its best performance, more than 70%, due to luck, basically. Now, this is speculation. And some people like it. Some people elect to speculate this way because they believe in over the long term they will get many outliers that will boost the annualized return, and it doesn't matter if the drawdown is high, they will make significant profits over the long term. This kind of strategies, they have long periods of underperformance, winters, they call them, like from 2015 to 2018, and from 2009 to 2012. But I want you to pay attention to the fact that this is one strategy out of thousands possible strategies for trend following. I have an article on the blog on the huge optimization space of trend following. You can search the blog to find it. This is just one strategy. Trend following has a huge dispersion between the different models, and performance depends not only on the model, but on the universe, the contracts someone trades. So trend following is a million strategies. So speculation has high flexibility, and this also increases the risks of anchor point or even ruin. So this is an example of speculation. On the other hand, this is an example of quant analysis. That's an ensemble, the performance of an ensemble of three strategies. One strategy is doing momentum and mean reversion switching. The other strategy is mean reversion, and the third strategy is seasonality. They all trade ETFs, highly liquid ETFs. As you can see, there are no spectacular years here. The performance is as close to normal in terms of annual return as you can get. And this is what is highly desirable, especially for professionals. For example, the trend following CTAs, we discussed an example in the previous slide. Sometimes they have many angry customers because of multi-year underperformance. The quants, they want to trade off, they want to tame the trade-offs actually, and they want to have a more stable performance. So this is, I have a link to this ensemble, the dynamic 3, in the comments. So this is an example of quant, basically. And I'm not gonna go into details about who is a quant and who is a speculator, but as I mentioned, a quant is someone who understands the trade-offs in trading system development through the prism of skin in the game and experience. Usually a speculator is someone who doesn't care about drawdowns because they either have lots of money and they can wait, or they focus on annualized returns because of lack of experience and understanding of risks. So let's summarize here the dynamic 3 versus the futures trend following. Sharp for the dynamic 3 is 1.49, the maximum DD is 11.3, volatility is 8.2%, annualized return is 12.1%. So this is a good example of strategy that is the result of quantitative analysis. And trend following, Sharp is 0.79 for a particular model, but maximum DD is 33%, volatility is high, 17.5%, but also high annualized return, 13.9%. Now the difference, 180 basis points, is dramatic in terms of total return over the long term. So this is one reason speculators focus on annualized return, or what they used to call in the past absolute returns. Like in the 1980s and 1990s, people called trend following absolute returns. Now, it became apparent that this was not a good marketing term after the advent of asset allocation, so they changed it to crisis alpha or hedging or things like around protecting capital or providing convexity. These are all marketing terms. Rather, they are quantitative terms used by people for marketing purposes. They are meaningless. Meaningless terms. Trend following is speculation. Now, there are replicators who try to follow indexes, like, for instance, the Société Générale trend following CTA index or similar. But what they do is, due to the ensemble nature of the strategies that have very high dispersion, they end up with very low annualized return in the order of 6%, and then they have to leverage. So you end up with the same, approximately the same risks and minimal protection convexity, as we also saw this year when the market fell. Earlier this year, also trend following fell and provided no convexity. And the result was that some products who use leverage for stocks and trend following, they end up with very large losses and panicked investors. And speculation is good only for those who can stomach the pain and the long periods of underperformance and swings in equity. It's not for investors. It's not for the people who invest their pension money in markets and they want peace of mind. So, and this is this is an example of why I want to talk about this quant versus speculation thing and what is going on in financial, social media and blogs. There is a high level of confusion and noise, and lately there is an attempt to infiltrate quant investing by people who are basically speculators because they try to maximize their returns. But this is another subject. If you like this video, please subscribe and hit the like button. Here is my website, a link to the Dynamic 3 bundle, a free book, PDF, if you haven't subscribed yet, on the blog, Profitability and Systematic Trading. This is an introductory book published by Willie in 2008. This is how to contact me, and social media links and how to find my work. Thank you for watching. Have a nice day. If you have any questions, please comment, use the comments below. Bye.